Okay, I'm here. Okay, so I've had to restart the webinar because I had a problem with the GoToWebinar control panel. As I changed the screen over, the use of the control panel suddenly went from me. So apologies if you've got cut off during that trading workshop. I will be keeping an eye open on who's coming in, and the main screen should, the main screen's sharing now. So that's all coming back to normal. That's good. Okay. So Olufemi, thank you for joining. My apologies that I had to cut the webinar and start again. I think we should all be sorted now. Just going to give folks a couple of seconds to rejoin. Apologies to that, Olufemi, but everything's normal my end now, which is good. Okay, hello, Yasser. Apologies, I had to cut the GoToWebinar control panel. I'm glad you found your way onto this week's workshop. Okay, that's great. That's all working. So just as other folks are coming in, just going to mention about the disclaimer. Of course, as we look at different currency pairs, different options, different entries and exits levels, just a reminder that this is not trading advice. The whole point of this workshop is that it helps you guys understand how someone with a professional trading background views the market, so you can see how you can make decisions yourself. Let me just see. Now I've got, just gonna make sure I've got the right. That's the one we want. There we go. Right, we're back on track now, finally. Excellent. Well, we'll start this week together now. So, looking at the equity markets at the moment, if you remember, one of the key things that equity traders are sensitive to is risk. If the equity trader is feeling very nervous about risk, they tend to sell equities and buy bonds. So when a bond is being bought, you see the yield going down, okay? So in this scenario, we can see that the European indices are still down on lingering coronavirus fears. The market's sort of been focusing on this coronavirus, understandably, for the last few weeks. And, you know, we've seen an up and down spells. And at the moment, we're in one of those down spells, but it's only mildly down. You can see the Euro Stoxx is down -21%, the CAC is down -2.8%, so mildly down, and the Italian FTSE is in the green, and the S&P 500 futures market is actually in the green plus 0.10%. So when you're looking at the equity markets as a whole, it's a gentle down day. The Shanghai Composite finished in the green, so there was a positive day for the Shanghai Composite. So the reason for that is there's a number of big Chinese businesses finally coming back after an extended Lunar New Year holiday due to the coronavirus spread. So one of the ways that China tried to limit the spread of the coronavirus was extend the holiday so people stayed around, they weren't traveling, etc. Now, a number of key provinces have come back into the market as a result of this Monday. So that's why we're seeing a little bit of recovery in the Shanghai. There's a bit of optimism in China overnight, but it's being offset by you know, some downside concerns on the lingering coronavirus fears. And so the Nikkei is down, we had the Hang Seng down, and Europe is currently mildly down. So that's kind of where we are at the moment. Just going through some key events. We saw a surprise uptick in Norway's inflation, the NOK, to 1.8% versus 1.2% expected. Now, this isn't a currency pair I often report on, but I do keep my eye on the NOK. I just wanted to flag this up to you guys. That's a big inflationary beat. So 0.6%, that's a strong reading. So in terms of sentiment, for those of us who are used to, you know, following strong currencies versus weak currencies, we're just going to have a look at that chart, because we can see that there's going to be some strength that's come into the chart. And I was reporting on this with my blog this this morning for HYCM. I just want to draw your attention to this, because when you see, this is a good example of a fresh sentiment move. Okay, so let me show you. Okay, so here we go. So here's the euro NOK currency pair. Okay, and the NOK has appreciated in value. This was the announcement here. It's appreciated in value, okay, the Norwegian krona. And we know the euro is generally weak because there's a bearish outlook for the euro. German manufacturing has been slowing down. So all of a sudden we see a divergence between the two currency pairs. The strong currency pair is the Norwegian krona, which we see moving downwards because it's being bought. And the euro is the weak currency pair. So all of a sudden, the euro and the Norwegian krona, we see weakness. So that was why I was saying this morning around this kind of time, this kind of level, I was saying expect to find sellers at market and at pullbacks. So, for the rest of the session, I'm expecting sellers from this level, sellers from that level, and sellers any return back up to here. Okay, so potentially, looking at that chart, this could potentially be a trade that lasts for a few days, like a swing trade. So that's one to keep an eye on, the euro NOK currency pair. And personally, again, this is not trading advice, but personally, I'm thinking with that strong Norwegian krona, we've seen some weakness in the krona, but I can't see that lasting, because in Norwegian krona, there's some strength. Fish prices have increased, so that's offsetting some of the weaker oil prices, because the krona is impacted by US oil prices. But when the moves are steady and slow, there's less of an impact on the krona, but when they're sudden and sharp, there's more of an impact. So, potentially I'm looking for more downside here, and I'm looking for a move down to the 10 level. And that's not trade advice, but that's the outlook. The krone's got strong today, strong inflationary data. That's going to be good news for the Norwegian central bank. The euro is still weighed down, so I'm expecting to see more euro downside and more Norwegian krone strength. And I'm looking at a take profit level of 10, and I'm looking at a stop just above the 10.22 level. So that's what I'm looking at. Again, not trading advice, but just it's helpful to see sometimes how someone puts together these different information, and see that was it.
Piece in
it's
surprise on the coronavirus.
That is
a candidate vaccine targeting the novel coronavirus has been tested on animals, according to a report Monday on news portal yakai.com.
My apologies again.
Sources.
There we go. Sorry, I'm getting all the mistakes today in one go. Apologies. Now, this is the issue. See, surprise. It's that surprise uptick in noise inflation. And it's a real big deviation, 0.6%. So unexpected surprise. So for the rest of the session, and for me for the next few days, I'm expecting Norwegian krona strength against the euro. Okay. And the way I've put my stop, the area where I'm saying, gosh, I've got this wrong, just above this highs here. Because for me, if price goes back above these highs, assuming that price, if price goes to there, I'm still not wrong. If price goes up to here, no, I'm still not wrong. If price goes above here, above these recent highs, for me, that's, yeah, I'm wrong. I got something wrong. I've analyzed the trade wrongly, and that's where I'm exiting my trade. And likewise, I'm taking profit just above the big round number here at 10, okay? So you can have a look at that, and I'll try to remember to update you as to how I play the trade as we go along. Key geopolitical events. Another one I wanted to share with you. There's been some very thin trading volumes in the US dollar Chinese yuan pair over the extended Lunar New Year. So let me just quickly show you that, okay? So you see, this is the new usual volume of US dollar Chinese yuan currency pair. And after the holiday, that's more than halved. So these normal levels have halved in the holiday time. So we haven't seen much US dollar Chinese yuan trading going on. And what's interesting is that the region that did return has been Beijing. Now, Beijing was the largest US dollar buyer in 2019. Okay, so it's the largest US dollar buyer in 2019. But the eastern provinces have now returned, and there's 3 eastern provinces just returned, which are the largest yuan buyers. So that's why into the end of last week, I was expecting US dollar Chinese yuan weakness. That's what I was expecting on Friday. Okay, so looking at the chart, we'll just have another less traded currency pair. And we can see, so price, okay, very interesting, because price moved up to this area here and pulled back, and it's this 7 level is a key resistance level. If you zoom out your chart, you'll see that the 7 level is a very big resistance level. Okay, so again, in this currency pair, now with the eastern provinces back, get and stay below that 7 level is key. Okay, so if the markets gets and stays below that 7 level, we also have a rejection of a descending trend line. You can just see here, if you just draw your trend line in down, I'll get that. I just want a trend line. Let's see if it will let me do it. There we go. And just see, you're kind of rejecting 1, 2, 3, 4 kind of rejections. So for me, I'm looking for more yuan strength. Now, what would invalidate that outlook? What would invalidate a outlook to the downside is if coronavirus fears get worse. Okay, so that results in the Chinese yuan being sold off. Okay, if it gets worse, then we're up and above. Remember, the market's still sort of fairly optimistic after the US-China phase 1 trade deal. So this recovery in the US dollar Chinese yuan pair has been on coronavirus fears. Now those fears are starting to recede. Now exactly how it will play out, no one knows. But if the fears do recede, I'm expecting more downside. If the fears maintain and the fears or get worse, then we'd see a break of this level. Okay, it'd be a break and then a retest of that level potentially for more upside. Otherwise, I'm favoring more downside because the view that I'm taking is that the coronavirus fears are going to pull back, they're going to recede. Okay, but again, that is my view, and it could easily be wrong. So again, if I'm wrong, where I'm getting out is at this 7 level here. So that is my perspective and how I'm looking at the US dollar Chinese yuan currency pair, but particularly looking for some yuan to come into the market now with these eastern provinces coming back. So that's the way I'm looking at that. EU-UK trade negotiations, don't forget the pound is still pressured on these EU-UK trade negotiations. We saw some pound weakness today, and a little bit of pound strength has come back in since this early weakness this morning. But we're trying to break through this key support level on the pound US dollar currency pair. You can see that key support levels here around the 1.3 region. So that's kind of the line in the sand. A break and a close below this level is important for Friday. So we're favoring more downside now on the pound technically, and the catalyst for that will be any more bad EU-UK trade negotiations. Both sides are really sort of getting more stubborn in their stances. So just look out, expecting more downside in the pound. And oil is worth looking at as well. Now, I want to look at oil because I did a video on oil recently because it's a really good example. Sometimes when you're trading a currency or a commodity, you're not just looking at one issue. You can be looking at multiple issues at the same time. So we're looking here, that 51 level here. Okay, that 51 level is that key support term resistance. Okay, so we're underneath that level now. We've had a break and a close. Little tip, technically, when you see a key level like this, when you see a break and a close below that key level, that's a sign. It's a sign that lower prices are generally ahead technically. Obviously, the fundamentals will drive it, but from a technical perspective, that is a negative move to the downside. So technically, we're looking at that, but there's 4 major factors influencing oil. And it's important when you're trading to kind of have a knowledge of the different factors that will influence price. So oil's really good because there's 4 quite different factors. and I want to run through them briefly with you. First of all, there's supply levels. The general problem in the oil market has been that the market is producing too much oil. We're producing more oil than we can actually use as a globe. So obviously, if there's oversupply, that's going to result in lower oil prices. So OPEC have been trying to limit the production of oil to therefore artificially inflate and keep prices up. A country like Saudi Arabia, they need oil to be at $80 a barrel, okay? So you can see what a problem that is for them with this recent fall, you know, for a number of years, oil falling down 50, 60, even down to $30 a barrel, okay? Really, some really low oil prices. Makes it difficult for a country like Saudi Arabia to balance their budget. Russia only needs $40 a barrel to balance their budget. So they're in the credit at the moment because it depends how easy or difficult the oil is to extract that influences the price. Obviously, the easier it is to extract the oil, the better it is for the country, okay? So supply, the world is producing too much oil. Obviously, we had the controversy over US shale providers as well, and that added more supply to the oil market. That's why we've seen this downward pressure. So that's number one. Number two, there's OPEC potential cuts. Now, when OPEC announce cuts, generally that's supportive for oil market. When OPEC say, oh, you know, if OPEC suddenly said, we're going to drastically recut our production levels, you know, much more than expected. We were expecting a cut of 600,000. We're going to make it 1 million, you know, then all of a sudden you're going to see oil prices spike. Then they're probably almost certainly not going to do that, but it just serves to make the point. So if we get production cuts, then that's supportive for oil prices. So recently, OPEC Plus and Russia have been saying that they may be looking at cutting interest rates. Sorry, they might be looking at cutting production levels in order to support the oil market. Okay, so you can see here, look, you've got one pressure, supply levels, it will force oil down, cuts will force oil up. Begin to see the issue? Now, thirdly, coronavirus demand reduction. The general consensus is that with the coronavirus spread, there's going to be a fall in demand between 1 to 2 million barrels per day from China. Okay, that's why during the coronavirus outbreak, we've seen the fall in the oil market because the market's thinking, well, we're not going to have so much demand for our oil. So, fourthly, there's been some civil trouble in Libya, and there's been a number of ports closed. These ports are large oil-based ports that export oil from Libya, and with those ports being closed, that has been helping to support oil prices, keeping them up. So look, you can see supply levels and coronavirus demand reduction moves oil down. OPEC and Libya ports move oil up. So you can see you've got to balance these four factors at the moment, and the oil market is going to be moved around depending on which of these stories is winning. At the moment, technically and fundamentally, we can see that the coronavirus and oversupply level is winning. So if we go to the monthly chart, you can see that there's a large bearish engulfing bar. 1, 2, 3, 4, 5, 6, 7, 8. 8 of the last whole months have been consumed by this bearish outside bar. Had a similar one here, fall down into this level. So look, you know, technically we're looking for a fall down to that level, but again, you know, as I explained, we're not technically driven traders. We are using the technicals and the fundamentals, but it's always good to be aware of what's happening and which way the market is looking like it's going to go. But these four factors are going to be what's going to either push it that way or not. We're expecting an announcement anytime soon from Russia whether they're going to go for the cuts or not. So that's something to be aware of. Good. Okay. The coronavirus update, total new cases over 40,000, 908 deaths, which is more than deaths to SARS in 2003. Okay. So it's a very serious situation still, but it seems to be one that the market thinks at the moment it can handle. But we're in the balance. No one knows what this coronavirus is really going to be like. No one knows how far or fast it could spread. So it's just a case of watching and keeping an eye on each update day by day. If we do get a coronavirus return to big concerns, we're going to see gold bid, yen and Swiss franc bid. We're going to see more oil sellers, Australian, New Zealand dollar, Canadian dollar sellers, and equities being sold. That's the playbook for the coronavirus if it gets a lot worse. And similarly, we're going to see the opposite of that if the coronavirus begins to recede. We'll start to see oil buyers because everyone thinks, okay, that's fine, oil demand will come back. We'll see yen and Swiss franc will be sold because they're not needed on safe haven demands. Australian dollar, New Zealand dollar, Canadian dollar, they will pick up as well as typical commodity currencies. We'll see the commodity markets return to strength. We'll see gold sold off as the safe haven play is rejected as the market calms and equities being bought. So there we go. That's the playbook for the coronavirus. That's what we're generally expecting, and that's typically what you expect in a risk on or a risk off environment. And the particular trigger at the moment just happens to be the coronavirus. So that is what's going on in that market. Now, I wanted to share another thing with you. It's got quite a lot to share with you this week, but it's all good. So now this is the S&P 500 white line, and this is the US 10-year government bond yield blue line. Okay, so generally speaking, these two move together. So S&P 500 goes up as the US 10-year yield goes up. As the US 10-year yield goes down, the S&P 500 goes down. That's the general pattern. At the moment, there's a divergence. And you can see, look, January and Feb, you can see that at the moment, S&P 500 is going up, whereas the 10-year US government yield bonds are going down. These normally move in harmony with each other. So there's what's called a divergence. Now, they very rarely go out of sync. So the fact that they're out of sync is significant. And the question is, and the people are asking in the market is, well, which is going to go first? Are equities going to fall down in line with bond yields, or are bond yields going to rise in line with the S&P 500? So we don't know that, but what we do know is what will most likely push that in one way or the other will be the coronavirus. So if all of a sudden it quickly recedes and, I don't know, there is a vaccine, or it's suddenly discovered something like, oh, aspirin can treat coronavirus, you know, we just found out something as simple as that, then you would expect the equity markets to keep rallying higher and the government yields to rise as well, okay? Because you'd expect that recovery in risk appetite, which tends to be yields up, currency up, equity market up. That's what we'd typically expect for the US. If that doesn't happen, if coronavirus gets worse, maybe they say it's much more serious than we thought, we can't control this, and then you start getting multiple breakouts in US, Germany, UK, Japan, and you know the single figure numbers start going into double, triple digit, it starts spreading in schools, this kind of stuff. Then if we saw that, we'd see the S&P 500 fall down in line with government 10-year yields, because obviously if China and the problem for China spreads over the whole world, it's going to affect global equity markets, and investors will suddenly go, well, it's going to have to hit the US market, so US companies won't be able to trade or do so much business if everyone's sick. It's common sense, really, but that's just the relationship that's going on with that. So we're going to go now and look at the week ahead, because I want us to make sure we cover the week ahead as well, and not just all these extra nice bits, as it were. So here we go. So overnight, we had some pretty strong manufacturing PMI data out, pretty much ignored by the market because it's all the coronavirus fears really at the moment. But that's solid for Chinese manufacturing. That's the private manufacturing data, which tends to you know, is less coverage of the large state-run companies. So 51.1, that's very good news for manufacturing. Oh, sorry, this is February the 3rd. With February the 10th, we did have some data out today as well. What do we have? Chinese data, got confused. Yes, we had Chinese CPI data. This was the one, February the 10th. 5.4%, again, very, very strong number. That's excellent. It's largely ignored because it's a coronavirus fear, so it's the same as last Monday. But that's been good news for China, good inflation data. Very light calendar for the rest of the day, nothing particularly for us to move. So in a day like this, what's moving the market is the coronavirus concerns. It's risk on or risk off tones. That's what's driving the market. So look for that as we go forward into the afternoon session and we get the US cash open in just over an hour. Preliminary GDP for the pound potentially could move the market pound. Again, the real big issue with the UK is the trade talks. So at the moment, I'm still expecting rallies to be sold. So the potential for a print here is if you've got a very strong reading, it could be faded. Okay, so if you get a good GDP figure, you could find sellers come in onto a good number. So be aware of that. Again, the rationale is, okay, good GDP, but tough EU-UK trade talks, so sell the pound. President Lagarde is speaking tomorrow. She has the possibility to move the euro, but as I said, there's no new kind of policy come out from Lagarde at the moment. She's sticking with her guns. She's undertaking a slow review of monetary policy for the ECB. So everything's staying as it is pretty much at the moment. So look out for any deviation. So any news from her that things are changing or speeding up, or if she said something like, oh, you know, we're going to have to look at more easing measures because of recent poor data and coronavirus concerns, then you know we're going to see the euro sell off. Be aware of that. Now, Fed Chair Powell's testifying. Again, something to be aware of. It's the chair of the Fed. So just like the main leader in the ECB for the European Central Bank, Jerome Powell's the chair, the main leader in the Fed. So what he says makes a difference. And the thing to look out for the US this week is particularly this data point here. It's the inflation data on Thursday. Now, the Fed has been concerned with low, subdued inflation. So in other words, when a central bank tells you that one data point is a particular concern to us, then we need to pay attention. Okay, so the CPI data is a concern. So in other words, if you get a really good CPI data number here, that's going to be very positive for the dollar. Okay, you're going to see the dollar index, you know, spike higher, euro, US dollar, spike lower. And the key reading of these two is the core CPI. So the Fed is concerned about low inflation. So if we see this inflation picking up, we're going to see some dollar strength. And similarly, if we see this CPI data falling, then we're going to see inflation levels lower. Okay, we're going to see US dollar lower. So this is in focus for the Fed, so it should be in focus for us. So although we got Jerome Powell speaking at 3 p.m. GMT on February the 11th and Wednesday, February the 12th, we're at 3 p.m. again. They are important for the US dollar, but this is the most important data point for the US dollar this week. So be well onto that. Don't miss that. There could be good opportunities there for trading. The Governor Mark Carney speaking again, February the 11th. Yep, can move the pound. So one to be aware of. We know the situation with the pound. 2 trade talks to try to negotiate, one with the EU, one with the US, and then countless of other trade deals the UK wants to arrange with the rest of the world. So the UK has got a headache on its plate. So look for any reference to that from Carney, or any good news would obviously lift the pound towards that. So just be aware of Carney speaking. The main event for the Antipodean currencies is clearly February the 12th, the official cash rate for New Zealand. Now, this is a significant data release. Obviously, we're looking at the rate level. Now, let me just show you what I'm expecting. Have I got this? Yeah, here we go. So the RBNZ, they surprised the markets when they held back in November of last year. They held at 1% versus expectations of a cut to 0.75%, okay? So again, the RBNZ are expected to hold their interest rates at 1%. And the committees agreed the general risks to the New Zealand economy, in their words, were tilted to the downside, and agreed it would add further monetary stimulus if economic developments warranted it, okay? So that's been the situation with the RBNZ. It would add extra stimulus if needed, okay? So we'll just have a little look. So going back, we'll go from, since that meeting was in December, it was in November, that was the last RBNZ meeting. And you can see business confidence is, pulling up those lower levels. GDP was up 0.7% December, so not bad December data. January, business confidence again, that's a minus number, but just remember how low it has been. So it's all, look, it's been these low numbers hitting at 40, 37, so even a 21 reading is a bit of a recovery, okay? So that's not too bad. Manufacturing index, okay, still just below the 50 level, but just pulling back from some of those deeper, darker moments that the New Zealand dollar experienced. CPI data tick up 0.5%, and actually the year-on-year reading was just 1.9%. So the mid-band for the RBNZ is 1 to 3% inflation level. So that's just like roughly in the middle. So that's, not too bad at all. And then we had an unemployment rate out last week, 4% versus 4.2% expected. Okay, so that was very good. Employment change was down a little, but you take it as a whole, and you can see that the general data has been fairly firm for the RBNZ. So we can see that going into the meeting, but the market probability of a rate cut, see the meeting's 12th of Feb, the market probability of a rate cut is like 6%. So the market is not expecting a cut really at all, only 6% chance of a cut, so that means very unlikely. And it's holding pretty steadily. So what we're looking for on this, we're looking for on Wednesday, looking at the policy statement, we're looking for a deviation. The way you trade and the way markets move is on surprises. So any surprise from that level, we've seen what we've expected. We saw what the RBNZ said in November. We've seen the data since, so it's okay. It's pretty good data, should be on hold. So if they went out on February and said, oh, we're really concerned about coronavirus, and we're going to look at cutting interest rates at our next meeting, then of course the New Zealand dollar would fall, and you need to be prepared for that eventuality, because that would be a very quick trade, and for investors clued into this kind of language, they would quickly be selling the New Zealand dollar. On the other hand, if the RBNZ said, our economic data has been good, unemployment is down, our GDP levels are up, our inflation level is just nearly our midpoint, we're more optimistic, and we think that the next policy rate move will be up rather than down, then we're going to see New Zealand dollar strength. So knowing the baseline helps us. So guys now know the baseline, so go away, look at this event, see what happens, learn from it, so you can learn yourself, okay? Again, Governor Orr speaking, remember, whenever you've got an interest rate statement, and then you often have like a governor speaking straight afterwards, so you can see here the press conference. So that is an opportunity for the governor to say something that maybe the market's missed. So if the market read 2 words in the policy statement and thought this is very bearish, the press conference gives the governor opportunity to kind of question that and say, oh, you know, the market maybe took this sentence to be more bearish than we meant it. You know, we said we might consider cutting rates, and the market's focused on that. And then, but the governor might say, but we really don't really see that as a likely possibility. So it's those kinds of clarifications, qualifications. They come from the press conferences and the governors. Okay, so be clued into those two events, this one and that one in the evening. So remember, New Zealand dollar traders, look out for that. Governor Lowe speaking, yeah, that's important, particularly when we've had a move for the RBNZ. So look at the Australian dollar and New Zealand dollar currency pair for when you get Governor Lowe speaking as well. It could provide an opportunity if you suddenly got a divergence between the two countries. US dollar CPI, we've covered that earlier in the session. Core retail sales, the general consensus is that the form that the US consumer is usually strong, so expecting strength there. And if there isn't any strength, then that would obviously be a surprise for US dollar weakness. Okay, guys, that has been a whistle-stop tour through quite a lot of issues today. Don't forget, we will be back again, not tomorrow this time. We'll be back 12:30 on Wednesday for our workshop. So do come up again for Wednesday and we'll go through the workshop, and I hope you have a really good week. Hope you trade well. Look out for some of those. I'll give you a little test before we go. Look at the things I've mentioned and then think to yourself, what would invalidate the outlook? What would make this outlook irrelevant? What changes the outlook? Because the more you see the changes, sometimes you'll get a fresh opportunity, and something you were selling, you can end up buying if the market changes. Okay, guys, I hope you have a good week, and I look forward to speaking to you soon. Take care now. Goodbye.